Hi, everyone, joining in early. Welcome. And we'll be getting started in just a couple of minutes now. While we wait, please feel free to drop in the chat where you guys are joining from. We always love seeing the cities and communities our people are joining from. Drop in the chat where you are from. We'd love to see that. Oh, nice. Boston in the house, guys. This is awesome. Everyone who just joined, for anyone who just joined now, please feel free to drop in the chat where you are joining from. Keep dropping the location. I'm bookmarking this in my head right now. Boston again. This is lovely. Do we have anyone from Ohio join in? All right, Boston, Boston. Denver. We have people from Denver joining as well. Kansas. Lovely. See, this is the reason why I love this community so much. It's so diverse. And just so you guys know, so we are officially starting at 7 p.m., which means we have like around what, 22 seconds left before we formally start. So till then, anyone joining new, drop in the comments, or drop in the chat where you guys are joining from. I'm saying Kansas, Denver, Boston, Boston again. All right, we have around 5 seconds left. 3, 2, 1. There you go. Hello and welcome, everyone. Thank you so much for joining us today for Nepali Leaders Network's Leadership Speaker Series. My name is Alicia Khatri, and I'm going to be the host for today's session. At Nepali Leaders Network, our mission is simple: to empower emerging and established Nepali leaders to connect, to grow, and to give back to the community. Leadership Speaker Series is one of the many ways we do that. It's a space where we bring inspiring Nepali leaders to share their lessons, to share their journeys, and to share their insights so all of us can connect and grow together. Today, we're incredibly excited to have with us Mr. Sanjay Manandhar, CEO of Zifino. Sanjay Dai has spent decades building companies across technology, cybersecurity, digital media here in the US. He helped bring internet to Nepal and used to pick tech stocks for a 12 billion euro fund. He brings a long term perspective on entrepreneurship, leadership, and also personal finance. And today's session is going to be specifically focused on personal finance for students and early career professionals. With that, let's jump right into it. Sanjay Dai, welcome, and thank you for joining us today. Do we have Sanjay Dai join in already? Looks like Sanjay Dai is facing some tech issues to join. I'll be helping him do that. Till then, guys, keep dropping in the chat where you guys are joining from. Uh-oh. All right. Sanjay Dai's internet just dropped, so he'll be joining in 2 minutes. Till then, drop in the chat where you guys are from. I'd love to see the cities our people are joining from. Boston. We have a lot of people from Boston joining today. Anyone else from Nepal, maybe? Boston. I see Boston a lot, and I must say, I'm really jealous of people in Boston. Anyone from Ohio? Anyone from Columbus? Anyone from Nepal? Do we have anyone from Nepal? Oh, we do. What time is it in Nepal right now? Around 6? Early in the morning? We have somebody from Worcester's as well. Wonderful. California. Springfield. The chat is already looking like a travel map, guys. Wonderful. Welcome, everyone. It's 5:45 a.m. in Nepal right now, and you woke up for the session. Thank you so much. We're really grateful. Atlanta, we have people from Springfield as well. Lovely. I'm seeing Denver, I'm seeing Nepal, I'm seeing California, Nashville. We have people joining from Nashville as well. Shout out to Boston for bringing so many people in the session. Lovely. Mm. Keep dropping in the chat, guys. Whoever joined just now, drop in the chat where you guys are joining from. We'll be starting in just a few minutes. Uh, the speaker, Sanjay Manandhar, will be joining us in few minutes. Mm. All right, Sanjay Dai, welcome. I guess you're mute, we can't hear you.
How about now?
Yeah, we can. Welcome, Sanjay Dai. Thank you so much for being here.
Thank you.
All right, everyone. Really glad we could make this happen, and I'm sure the audience is going to get a lot from it. I'm 100% sure on that. Okay, a quick housekeeping note, everyone. So, at any point of the session, if you have any questions or something resonates with you, please feel free to drop them in the Q&A tab. For the questions, Q&A tab, not the chat, because that is where I'm going to be pulling the questions at the end for our Q&A forum. So, any questions, go to the Q&A tab, the normal conversation in the chat. I'll also clarify the format of our session today. So to start us off, Sanjay Dai will be sharing with us a short presentation where he'll be sharing his journey, his insights, and what he thinks about money and decision making. After the presentation, I'll come up with a few follow-up questions if I happen to have any. And after that, we'll open it up for the audience Q&A. We'll try our best to go through as many questions as we can. So with that, we'll hand it over to you, Sanjay Dai.
Awesome.
Slides presentation.
Great. Okay, let me see if the slides work here. First of all, thank you very much for allowing me this opportunity. I don't know how many people are in the audience. I can't see you guys, but this is, Nepali Leadership Network's first event of 2026. So happy to be doing this. And I'll tell you the motivation for doing this is that when I was in my early 20s, I felt like I was educated, even in college, educated, but I wasn't fluent in financial matters, especially personal finance matters. Nowadays, there are many more resources, but I thought maybe instead of having all of the internet at your disposal and not knowing where to start, maybe having someone like me who has made a lot of mistakes, you can learn from my mistakes. So that's the reason for this particular event. Let me see if it works for all of us. I'm going to share a very short slide, maybe 10 or 15 slides. Let me know if you can see this.
I can see that. I guess. And if you are sharing like audio or video, make sure you share the tab audio as well. It's
Okay.
video audio.
No, the video, China, just images. So, okay. Let's first of all, it's about personal finance. In case you decide this is the wrong event for you, this is a good time to say thank you and goodbye. But I hope what you'll get out of today is that how to think about money and finance and wealth for the long haul. But you need to start with the right kind of foundation. So you might say, why this guy? Why is he saying all this? Well, early in my career, I was more a techie. As you can see, I went to MIT undergrad and grad, electrical engineering, computer science, worked at places like Sun Microsystems, Siemens, and all that. But I decided, I just wanted to have a slightly different perspective and career trajectory. So that's why I went to business school in France. And right after France, even though my offers were all tech and all that, I took a very unusual role, and that was of picking tech stocks in public markets for a company called Newton Investment Management. They had 12 billion pounds under management, and their exposure to technology was zero. And the reason for that is that they considered technology to be very volatile. So this was 1996. So for about 3 years, I picked technology stocks, all public markets, anywhere in the world for them. And we did quite well. You probably know what happened in the late 90s for technology stocks. After that, I just didn't want to be an investor, at least investor professionally. And so I started actually, building companies like Aerva, Wicket, and the current one is called Zifino. So let's start with this picture. I would say the foundation of a balanced life, first and foremost, is your health. And that's why it's at the bottom. There are aspects that are very important. And I would say relationships, friends and family are very important, obviously. Education and skills are also important. And really, to make everything work, you need to have a bit of wealth, right? But here's a different view. You can also have a very unbalanced life relative to wealth. Here on the left one, we have wealth that is completely outsized relative to health, relations, and education. And there's a red line here. That red line to me is what you need to really have enough wealth, but not too much, right? So on the left side, we have too much, and sometimes, this is too philosophical. I won't get into that. But having too much money, almost, and especially too quickly, can really have devastating effect for at least relations, sometimes health as well. So, but the other side is also not interesting, right? Meaning, if you have too little and you're always struggling, and you're below your red line, it is not so balanced either. So this presentation is about how to get you past the red line, especially after you're, past your 20s. By the way, it's important and good to struggle a little bit, especially in your younger ages. So I'm sure you all know, probably the most important parameter to wealth creation is time. And this is why I think I'm speaking to mostly younger folks, but really any time in your life is fine. But the younger you are, the more time you have, more time for your wealth to grow. So, this simple formula already, I'm sure. Principal times 1 plus rate to the power of time. Remember, this is power of time, right? Power of is exponential. Human brain has a very hard time with exponentials. We understand linear very well, but we don't understand exponential like that as well. Because of exponential growth, time is the most important element. So if you're in your 20s, you may have 20, 30, 40 good years for your money to grow. And that's why, here's an example. If you're a principal, or if you start out with $1,000 and you just let it sit for 20 years, letting it grow compounded at 10%, you're going to have $6,727. That is more than 6.7 times your money, right? So here's an example. So there's a principal, the green one, principal means the money you started with, that doesn't change. Although with inflation, if you put inflation at 2% a year, it's compounding negative 2%. So your money is actually losing its buying power by negative 2%, give or take. So you cannot just leave your money in the bank. It's not going to help. Instead, you'd want to invest it in an asset class that grows by more than your inflation rate. So compound interest and time, most important in your wealth creation is the amount of time. If that is the case, you better get started early, right? Invest early, leave it alone. Here's an example. S&P, which is the public stock index of 500 important companies in the US is called S&P 500. S&P 500 has grown historically at approximately 10% a year. If that is the case, and you put $20,000 as a principal and let it grow for 25 years, it'll grow to 216,000 to 727. Let's say you're able to put 50K and let it grow for 30 years, it'll be 874. If you put 50K and let it grow for 31.45 years, you're a millionaire. It'll become $1 million. So again, look at this chart. It is not linear. It is growing exponentially. This is the most important thing. Because of this, if you're young, or really any time, but especially if you're young, find a way not to use all your money. Find a way to put a little bit aside. And if you can put it aside in an investment capacity, even better. So I know Alicia has many questions for me, but and I'll go through this very quickly. There's a thing called the rule of 72. If you divide 72 by the growth rate, that is the number of years in which it will double. Remember, I said S&P has been growing by approximately 10% compounded every year. That means whatever you put into the S&P, in 7.2 years, it should double. You put 10,000, it'll be approximately 20,000 in 7.2 years. You put a million, it'll be 2 million in 7.2 years, right? The same applies for things like credit card debt. Remember, now credit cards are starting to charge 25% interest. Your credit card debt in 2 years and 10 months is going to double. If you have $5,000 in credit card debt and you don't pay it off, just let the interest accrue, it's going to be double into a little less than 3 years. Not good. Again, rule of 72, right? Divide 72 by 2.5%. That was the growth rate of Nepali population in the 70s and 80s. And you can tell, when I was a teenager in Nepal in high school, we were about 14 million people. In 29 years, it doubled. So you can imagine any country whose population doubles is going to have a lot of challenges. And that's why whenever you go to Kathmandu, it's just like people are pile on top of each other, right? Houses pile on top of each other. So remember the rule of 72. Divide 72 by the growth rate, and it'll double in that number of years, okay? The reason I bring that up is to first and foremost talk about debt. There are different kinds of debt. Some debts are important for your everyday life. Some debts you really don't want any part of. Look at the interest rates. The higher the interest rate, the shorter time it takes to double, right? We just found out from the previous slide. So because credit card debts are one of the more, have one of the highest interest rates, use the credit card, of course, for everyday expenses and so forth, but please do not roll over your credit card debt. Just pay it off every month in full. If you cannot pay it off, what it's saying is that you're living beyond your means. And of course, if you're accruing your credit card debt more and more, your FICO score or your credit score is going to be affected as well. So this is a debt you do not want. I did not say do not have credit cards. You should have credit cards. That'll improve your FICO score, but you want to be done. You want to be paid off every single month. Credit card debt is one of the most pernicious and most dangerous debt you can have. Some of you probably have student loans. That's a debt. But sometimes if it's government guaranteed and all that, it's anywhere between 2 to 10%. Of course, that's an investment in yourself. So that's why it may be important. Of course, you can also get student scholarships. Try to get scholarship first. Try not to get student loan. But if you can, try to get it government guaranteed. Car loans, you need to get around. Car loans are what they call securitized debt. It's secured against the car, which is an asset, or a mortgage, which is secured against the home. So these have usually lower interest rate. Why? Because they can go get your asset if you don't pay up. So these are important loans for everyday life. It is important to have them. It is practical to have them. It is not so practical to have credit card debts. And of course, debts from to and from friends and family, I really do not recommend it. But of course, in times of emergencies, you may need to use them. I hope people are tracking along. I can't see anybody, so Alicia, I hope everyone's okay. Okay,
Everyone's doing good.
they're
And
doing
just a
well.
second,
Okay,
if you
yes.
want others to be seen, what we can do is so can you see an option on top right? Picture in picture भनेर लेखेको होला स्क्रिनको तल सानो एउटा स्क्रिन
Oh,
जस्तो एउटा
okay, good. I see you and me still. Bring back. Okay, it's okay. We'll just continue like this. Okay, so I wish I had this slide when I was coming out of college. I did not. So I made a lot of mistakes, as I just said. So again, let me repeat it. Please, let's try to minimize bad debt, like credit card debts. Have no debt. Credit card's okay, but no credit card debt. You want to maximize on Roth IRA. So Roth IRA stands for Independent Retirement Account. But the Roth is a particular type where your IRA goes in after you pay tax. Because of that, there's a limit of 7,500 per in 2026. Every year, the government actually uh, uh, increases it a little bit, but also it's not for everyone. It is only for people who make less than 150K or so. As an example, I don't qualify anymore. So, but it is probably the most important type of retirement account. Why? The reason is once you put that money in, whenever you take it out, and of course, you cannot take it out until you're uh, 60, 60 about 60 ish. It varies actually, but there's a retirement age, let's say 60 years old. You cannot touch it until 60 because there's going to be a lot of penalties. But after that, any amount you take out, even though it may have grown, remember it's going to double every 7.5 years, right? So anything that doubles, anything that it has grown into, you do not pay taxes on it at all, ever, as long as you're in your retirement age. And this is very important because the government likes to take a bite out of any gains you make. A traditional IRA, actually, let me see if I have that picture. A traditional IRA, you pay taxes when you take it out on retirement, but you do not pay any taxes when it goes in, right? So traditional IRA, no taxes, and you pay taxes when you withdraw. Roth, you put uh, you pay taxes, and again, we're making a big assumption here. When you're young, your tax bracket is low, say 20%, but when you're in your late 50s, you're going to be at, let's say, high 30s tax bracket. And you might say, what is 15, 16%? Well, 15, 16% of $1 million is a lot of money, as an example, and it could be multi-million dollars, right? So that's why, if at all possible, put as much as you can to the absolute limit every year into the Roth account. 7,500 this year, 7,500 next year. Just keep doing that every single year until you cannot do it anymore, meaning you make more than 150K. Okay? So, max. And then I'm sure many of you know about 401K plans. This is basically an employer providing a plan for its employees as part of the benefits. Some of them will match whatever you put in there as part of as a percentage of your salary. Typically, they match anywhere from 2 to 6%, but some do a lot more. Let's say your employer says we can match up to 6%. How much should you put? You put 6%, so you get 6% of free money from your company. That's a match. That's free money. Do not put 1%, do not put 0, do not put 5.5%. Put 6%. Why? Because that now you have 12%, and it's going to grow to be a very large amount. Remember, I said, put it away and forget about it. You'll collect it at 60 plus. So you want free money from people like your company. Anyway, and then one other thing, I'm sure a lot of you are thinking about buying a house and all that. How much should you spend on a house? The rule of thumb is no more than a third of whatever salary you bring in. Whether you're renting or owning, when you're owning, let's say you have a mortgage, you should not put more than a third towards the house. If you do, you're buying too much house for what you can afford. And of course, network, network, network. And if you're in this session, you're already doing a lot of good networking and learning. So remember, the balanced life. You want to have relations, you want to have your skills, keep yourself healthy, and the rest should take care of itself. Okay, good. Now, a little bit more of the S&P. Why do people talk about standard S&P 500 index so much? So you can barely read this, but I'll read it for you. This starts in 1871 and ends in 2023. You can see that this is how the index has been moving. The blue tells you how long the bull market has been running. Bull market means the stocks, the index was growing. The yellow are the times that they were mostly on the decline. And if you look at it, just even as a picture, it's mostly growing than it's going down or going sideways. There are a few times that it went sideways, and you probably remember them. Here's one in 2020. It's called the pandemic. Remember, it didn't even go sideways. It was a blip, and it went straight up. So let's say you're, an investor in March 2020. You're like, oh my gosh, the world is going to come apart. I need to get my money out of the market. Let me go into cash, sell everything and go into cash. Well, you're in cash now, and then look what happened. It went whoop, and it's still going up, right? The one before that was in 2008 and 9, called the Great Recession because of the financial crisis. The one before that was year 2000. But you see, net is going up, and you can here's a little chart that tells you if you look at 150 years of S&P, the returns without dividends invested is 9.47, and with dividends invested, without dividend invested is 7%, and with dividends invested, it would be 9.5%, give or take. Forget the 150 years. Look at the most recent 10 years. 11% without dividends being reinvested, and almost 15% per year with dividends being reinvested. And look how steep this growth is. That's why it's 15%. And if you look at only 5 years, this bit, it's even higher. It's 16%. So again, I hope this chart demonstrates to you, use the stock market in a way that you can grow your money. I always like to say, I like to have my products, my companies, my portfolio grow while I'm sleeping. So this is one that is doing the work for you as long as you leave it alone. Okay. Something, again, I have already talked about, but one thing that you want to think about especially when you're thinking about a home or whatever, is the 5% yield rule. What is that? A yield means what an asset generates in cash flow per year. Okay. So let's say you're looking to buy a home that is $1 million. And the yield on that is 5% would be $50,000 per year. Per year. So monthly would be 4167. So that means if you're paying less than 4167 a month, you should continue renting as opposed to buying that $1 million home, right? So that's the way to think about 5% yield. If you're paying more than 5%, then you're probably buying too much home. So again, how do you know it's too much home? 5% yield of $1 million is $50,000. We said. Remember, home should be no more than 3 times your salary. So 3 times 50,000 is 150,000. If your salary is not at least 150,000, you should not buy $1 million home. If your salary is a little bit less, 100,000, then you should buy a home that's a third a third less than $1 million. So $670,000, give or take, right? So that's how you do it. And of course, people say, but what is a safe down payment? Always 20%. If you can put more, great. If you can put less, maybe you wait a little bit. Of course, there are local variabilities, but this is one that as a young person, you're always thinking. And I want you guys to understand this 5% rule and how mortgages work and all that long before you're even buying are in the market to buy versus rent, right? So I personally bought much too late, in my opinion, and that's because I didn't understand this, and I just kept renting and giving landlords a good amount of cash flow. So we already talked about this. There are limits to how much you can put in Roth or traditional, usually about $7,500. Why? The government does this because the government does want to uh, be able to tax you. They don't want to give you free money, and that's why there's a limit. I mean, if let me also say one more thing. If you're a student and you don't have at least $7,500 in salary, you cannot put any money. You can put up to 7,500, but also it is limited by how much you made in that year. So if you had only a summer job and that was $4,000, you can put $4,000, but not more. You can't go up to 7,500. Again, the government has all these different rules to make sure that they're not losing out too much on taxing you. Okay. Another 5 or 10 minutes. So people say, okay, now I'm ready to start investing in the market. What should I do? So the question becomes, do you want to do an index fund like the S&P 500? Do you want to do a mutual fund, which basically means a bunch of stock with a specific theme? Mutual fund might be all the interesting stocks in mining, all the interesting stocks in technology would be too wide. All the interesting stocks in semiconductors, and then you put Nvidia, ASML, AMAT, TSMC, and so forth, and that becomes a mutual fund, right? But you can also do mutual fund by region. Emerging markets, as you can see here, emerging markets fund, or you can say foreign large cap stocks. And then, of course, the one that where you need a little bit more education, but is extremely interesting, is individual stocks. And sometimes people say, what's the difference between stocks and bonds? Stocks are basically an ownership in a company, whereas bonds are ownership in the company's issued debt. So you can have a small piece of the company that would be a stock. So you become a stock owner of that company, or you have rights to some of the payments of a loan that the company puts out. So typically, stocks are considered volatile, bonds are considered not as volatile. But again, there are many, many nuances here. I won't go into all of them right now. But here's one ETF, stands for Exchange Traded Fund, called VU. It's a Vanguard S&P 500 ETF. Remember, we said, let's say you want to buy the 500 stocks in the S&P 500. You have to go to one of the fund managers that will actually put it together for you. The Vanguard one is very interesting because it is a very large asset base, meaning a lot of people bought this particular ETF. And look at this. It's not highlighting, but its expense ratio is 0.03%. It's not even a third of a percent. It's 300th of 1%. It's very low, right? And you get to buy all the 500 stocks and pay Vanguard almost nothing. And so this is one that many people in the financial independence retire early, or also called the FIRE community, love. In fact, they call it VU and chill. Just park your money in VU and chill. Don't even think about it. Remember, I said, put money aside and don't touch it. If you had to, if I had to recommend one ETF or one stock, it would be VU and chill. Look at this. In 15 years, in the last 15 years, from 2010 to 2025, it grew 510%. Completely berserk, right? So that means, it's been, doubling multiple times. So that's one that, and again, the reason I bring up Morningstar is this nine square framework is uh, built by Morningstar. They call it large cap, means large capitalization, large companies, mid cap, small cap, and so that goes as rows. And then you have value in the left column, and then you have growth. Value means it's not growing very fast, but it's also not very expensive, and somewhere in the middle. Growth would be majority of the tech companies, and large growth would be tech companies like the ones Magnificent Seven, like Nvidia, Microsoft, Google, and Alphabet, and so forth. Okay. Another one ETF that is a bond fund. It's a fund, a basket full of different companies' bonds, and these are the examples. Lockheed Martin, it holds 4.59% of the fund is Lockheed's bond loan into the public. Bristol Myers, 4.22%. So, and it also tells you what kind of industry they are. So you can see what's the advantage of having a bond fund. If you feel you need access to if you want capital preservation, bonds are better. Look at this chart. This is comparing SCHD, the Schwab US Dividend Equity ETF, versus the red one is VU, which is the 500 S&P companies. So when there's a downturn, like there was from 2022 to 2023 and March, when there's a downturn, the equities like VU go down deeper. So the bond preserves protects the downside. Whereas when it's going crazy, if it's a bull market, the bonds can't keep up. So if you want growth, you want more equities. If you're a little bit worried that you're going to lose your money, you want to hold on to, you want to park it mostly on the bonds. If you're young, I'm not by the way, I should have said this in the very first, minute of the presentation. I'm not a financial advisor. You should not take advice from me, but for a young person to be in a equities or stocks, ETFs like VU would be quite amazing. Well, there's also individual stocks like Nvidia, and the ticker is NVDA. It has grown 1,327% in 5 years. And remember, now you guys are experts in what is VU and what's, so here's VU. The VU is the blue line, which is over here. Just gently, it's grown 85% in the same 5 years that Nvidia grew 1,327%. If you put $1,000 in Nvidia in 2020, it would be worth 14,265 today. But you might say, well, all stocks go up, right? No. Here's an example: NKE, that as a company, Nike. If you put $1,000 in it, you'd have $240 left today. So see, that's NKE. It lost 76% value in the last 5 years. So not all stocks go up. So you have to have your eyes open when you're buying individual stocks. So if you don't have the time or the energy or the inclination to be educated on individual stocks and companies and what they do and so forth, your best bet is a basket like Vu. But there are many baskets, by the way. Vu is just an example. But if you're diligent and you say, this AI thing is happening, maybe the GPUs are going to be important, and say 2020 or so, you put $1,000, you'd have 14,000 today. If you put $1 million, you'd have $14 million today. One final thing I'd like to say before I hand it over to Q&A is, in your early career, you have your three jars for spending, spending, saving, and giving. Of course, you need a lot of, in the early days, the amount of money is not a lot, so you spend most of it on needed spending. Later in your life, you'll spend more, but as a percentage of what you have is going to be very little. So it's going to, hopefully will be less in the jar, less that you'll spend, more of what you have you'll save, and a lot you'll give away, right? Spend, save, and give. And that's it. If you want to send me an email, I'm at hello@sanjaymanandhar.com. And in April of this year, I'll be putting out a book called The Power of Why Not. And there are many elements of what I've just spoken about in one of the chapters where I talk about my time picking tech stocks in the late 90s. Alicia, with that, I thank you and your audience for allowing me this opportunity to make sure our young folks are on the right track money-wise.
Oh, wow. Thank you so much, Sanjay. There's a lot of perspective in what you have just shared. I know everyone in the audience might already be reflecting on their journey. I know I personally took away a lot from how you framed money, not just as numbers, but more like decisions or habits, or something like long term thinking, you know? And I guess now is the time we can move for the Q&A, because we have some questions in there. Again, guys, have any questions, something resonated with you, please feel free to drop them in the Q&A tab. I'll be pulling the questions from Q&A tab and not the chat. You should find an option with a question mark on the bottom panel, somewhere in the middle. Click on that and drop your questions in the Q&A tab. While you guys do that, I will spend few times building on what Sanjay Dai just shared. I have a few follow-up questions,
Okay.
actually. Okay, so I know you mentioned somewhere in between about making a lot of mistakes. I actually wanted to focus on this one particular time. Was there any specific turning point in your life, maybe because of added responsibility, maybe because of success, maybe because of a stupid mistake that completely changed the way you looked at money after that, or let's say looked at risk taking after that? Was there any particular moment like that?
Um, it's probably transitioning from my 20s to my 30s. You're right. I mean, you start having a family and all that. And I must say, in fact, a guy named Mahendra Sakya, recently visited Boston after 30 years. And he was here when we were doing GBNC, started GBNC with him and all that. And so he was my house guest, and we're talking. And he said, you were such a socialist. You did not like money when we were together. So that would have been I was in my early to mid 20s. I just graduated from MIT and from the Media Lab and all that. And my view on money was almost that it's a dirty thing. You don't want to be associated with it. In fact, I even came up with a very small publication called Samachar Bichar, quarterly, and it became popular enough that there were businesses that wanted to advertise. And I said, no, we don't take advertising. We don't, this is for free. And so that was one thing, right? So having almost a purist and unpractical view of money. After business school, I realized what people are doing, and that with very little knowledge, they were actually making themselves very, very comfortable. And that is why I thought, okay, if that's the case, let me see what this, finance and stock market and all that is. And that's why I explored there. And after that, I've told myself, You can work hard or you can work smart, right? And so you should work your profession, your job, and have a salary for sure. That's working hard, working smart, making sure you add to your livelihood and knowledge. Well, let's just go back straight to the very first slide, right? Balanced life. Your education knowledge is important. It gives meaning to life, but also let the stock market and the asset creation do its job as well. Let it grow while you're sleeping, right? So I call that you know the smart aspect of money. Don't just work hard. So that's sort of the big transition from my 20s to my 30s, saying, there's a way to make your money work for you, not just you work for the money.
So, if I'm understanding that right, that moment really forced you to think about money not just as something that you shouldn't associate with, but more like something that everyone should have a knowledge of how to multiply, or I would
Yeah,
say.
and money is like management of any other thing, management of your friendship circle, management of your career, management of your education, all that. You also need to manage money, and the kinds of money I'm talking about is not just income and expenses. Well, that you need to manage. That should be fairly straightforward, right? I have this much coming in, and you want to spend less than what's coming in, right? That's budget. That's budgeting. What I'm trying to say today is don't spend everything. Put something away so that you'll have something for the rainy day. In fact, there's so much to talk about. It can be done in one session. So people always say, I need a rainy day fund. How much should it be? And the rule of thumb is 3 months of expenses, right? So little things like that. But again, I didn't have money coach. So I didn't know these things. That you shouldn't spend more than a third of your salary in rental or mortgage. But what if it's 10%? Oh, then you should park a lot of it, into the market or something. So if you're making a lot of money, you don't need to spend a third in a home if you don't need it. So these are little practical things that'll make everything easy down the road, because if the money part doesn't work out, like I said over here in the in this second one, if you're always below the red line and always everything is a struggle, as they say, hand to mouth, then it's not fun either, right? I mean, you need to do something so that it's not hand to mouth all the time, number one, but number two, down the road, when you're older, you want to make sure that you can you don't need to constantly be working hard, working your ass off all the time. So you need to think about the future as well. And this session is about how to think about the future and also try to make enough so that you have a balanced life.
Perfect. Thank you so much for explaining that so clearly. All this finance thing sounds like such a complicated topic, and there's a lot to learn about, of course, but thank you so much for putting it so clearly. I guess now it's almost 7:45, so now might be the time we look at questions. So I'm starting to see the questions come in. Let's start with the first question. The first question is from Dheeraj Thazali, and his question is, what percentage of my income should I put into stocks versus bonds versus other investments?
Again, let me start by saying I'm not a financial advisor, and what I say is what I would do for myself. So, because of the power of time, I would put as much as I can especially in my 20s, in the stock market. And I'll even tell you now, I'm in my late 50s. I have almost zero in bonds. Most people in their late 50s will say, now 50% stocks, 50% bonds. I'm just crazy that way. Why? Because I also have a little bit more knowledge. Remember, I used to do this professionally, right? So, and I'm also okay taking risks. Remember, the thing about the market is that it goes up and down, and there these little ups and downs. Let's say at this point, year 2000, you're going to retire. Your asset is going to be less by a third, right? So that's why they say close to retirement or close to when you need the money, you should not put it all in the stock market because the time. But if you're a young person and you're only in your 20s, even after it comes down, by the time you are, 45, you're way up there, much higher than here, right? Year 2000, year 2025, right? So there's one particular investment strategy called buy and hold, and that's one that that's one that I do, which is buy. And if you think it's a good company, I hold it. Even if it goes down, hold it. If anything, I buy more at the bottom. And this is why my largest position in my portfolio is Nvidia, because in 2018, when I was doing a computer vision, company, my two PhDs wanted to train our facial models using NVIDIA GPUs. And I said, wait a minute, why? It's so expensive. Why don't we use Intel CPU as we've been doing? And they said, Sanjay, it'll take us 5 times more time. If we want to go to the market quickly, we need to train with GPUs. So then I thought, if these two PhDs are saying that, how many PhDs are there that are using GPUs to train AI models? So that's when I started watching it. And once I start watching, if it start, and then it's like getting to know friends. These are my friends. And once I get to know them, okay, this is what they do, this is how they behave. And if they're high quality and they come down for whatever reason, because they had a very bad earnings season or whatever, you buy more. By the way, just so you know, it's very, very tempting to sell when you think the world is going to hell. Imagine March 2020, everything is coming down. Everything's down means more people are selling than buying, right? They're selling, so the price keeps coming down. And again, in my book, I talk about the wisdom of the crowds versus herd mentality. When market's oversold, people have an instinct to sell. It's the wrong time to sell. If anything, you should be buying. When other people are freaking out, you want to buy. When other people are saying, "Oh my gosh, this is the best thing ever," AI is going to be here forever. AI stocks are going to go to the sky. Is sort of when at least I start selling. So anyway, I hope that's helpful. And other investments. By other investments, I think people mean things like crypto, maybe real estate, maybe cash, gold. Again, I'm a very traditional guy. I have almost zero crypto. I have very little gold. I have just a handful of real estate and all that. I'm mostly a equities guy. So anyway, next.
Well, very well explained. So next question we have from Anonymous. Basically, their question is for someone who is starting to earn, how much should you have in your emergency fund or the foreseeable future? The investment that we talked about cannot be accessed when needed. But before that, how much should one have on their savings account?
I think I answered that question right at the very end. The rule of thumb is you should have 3 months of expenses in a liquid account. By liquid account, it does not necessarily mean cash. So the banks, so today the interest rate, I did not get into this, but there are things called T-bills, government treasury bills. The government treasury bills are yielding about 3.8, almost 4% nowadays. It's been over 5 about 2 years ago. So that is the first time I invested or I parked some of my assets in T-bills, not in my bank accounts. I do have checking account, I have savings account. They have almost zero. It's literally to pay the credit card that's due and all that, just for everyday stuff. Because why? Because the banks will give you, even when the T-bills are giving you close to 4%, they'll give you 0.5% in. They'll give you a less than 0.5% in checking, and they'll give you about 1% in savings. So yes, you should put it put your emergency fund, so 3 months worth of expenses, in a liquid asset. And the liquid asset could be T-bills. It could also be stocks, by the way. Just because it's in the stock market doesn't mean it's illiquid. In fact, it is more liquid. Your real estate may not be liquid. Your stocks in your shares in your private company may not be liquid, but the stock market is absolutely liquid.
Perfect. So next one we have in here. And after this, we might be able to take one or maybe two more questions because we are almost close to 8. Hi.
Okay.
All right.
Okay.
The question is from
Having
Angelinda.
okay, leaving one job to another work in terms of rolling over from previous job to another, is the rollover considered a withdrawal? Okay, absolutely not. Rollover is not a withdrawal. And please do not withdraw the money and put it back in a new thing. Talk to your IRA operator, provider, and tell them to move it from this to that, right? Because you cannot possess the money. If you possess the money, it's considered a withdrawal, and you're going to be charged 10% penalty. So a rollover is not a withdrawal, and typically a rollover is done from one manager to another IRA manager. But great question.
Wow.
Next.
Next question that we have is, okay, what is the most relatable quote you have ever heard that still stays with you?
Oh, it's by Louis Pasteur. The lucky are the prepared mind, right? So if you think people are lucky, but really they may be just be prepared. So it's true in life, it's true in investments. Yeah.
Very great way to put that. Next question that we have is from Anonymous. Have funds from 401k rollover and want to invest in the stock market. What strategies would you recommend for long-term growth and compounding?
From a 401k roll, want to invest in stock market, what would you have for long-term growth and compounding? Okay, so yeah, 401k is very similar to IRAs and all that, in that you cannot touch it until you're of retirement age. So again, it depends on, are you 45 and you're 15 years out, or are you 25 and you're decades out? Again, what I would do is I would put the 401k, by the way, is like an IRA that your company runs for you, and they give you options of what you can invest in. You don't always have all sorts of choices because it's provided by the company or a manager that they hired to run your 401k. But if I were young, I would put most of it in very high growth instruments or baskets. I would not put them in bonds. So
Got it. So next question we have is, if you had to give one piece of advice to your 20-year-old self, what it would be?
I mean, I imagine there are many things I would be saying, but I would say, in terms of money, uh, park as much as you can on Roth, and then the rest in stock market or an ETF like VU, and just leave it there. Don't even think about it. Forget it. And then, of course, after that, if you can, buy a rental property where you're one of the tenants, and you can also rent it to other people. As one of those things, Cambridge, Massachusetts, I had a job when there was a downturn going on, and someone said, there's a triple decker, they only want 140K. And I said, no, I don't want a mortgage. I want to travel the world, blah, blah, blah. But you can travel, you can buy a house and rent it and travel the world. So I ended up not buying. And so that it's just down the street from where I am. It's worth about $5 million today. And of course, not to mention the cash flow you'd have for the last 35 years or so.
Gotcha. Next question is, in this economy, is it still possible to spend only one third of income in housing, at least at cities like Boston?
Well, it might be yes. I fully sympathize with this question. The one-third rule is very, very hard to maintain in very expensive cities like Boston, San Francisco, New York, and all that. But if you think about it, because a house grows in a Boston area, it has been growing. And by the way, you can even chart the same way we did for S&P. It has grown by 2.5% over 150 years. If that's the case, and you have a little bit of cash, where should you put it? In a 10% grower or a 2.5% grower, right? So if you can, of course, we all need to live somewhere. What I would do is spend as little as possible. Okay, maybe not 1/3, but 40%, let's say, as little as possible in your housing situation, and whatever you can, allocate to the stock market, put it there, because one grows at 2.5%, another grows at a much steeper curve at 10%. So you'll be much happier 20 years down the road.
Very, very realistic answer. This one is going to be the last question, by the way. So I would like to know more about building credit scores.
Okay, great. Credit score, also called FICO score, is managed by the four credit card companies, and they're looking at they get reported all sorts of payments or delinquencies and all that from all your loans, your rents, late payments of all sorts. So it's basically a numerator and denominator. The numerator is how much credit you're using. The denominator is how much credit capacity do you have. So let's say you have a credit card that says you have $20,000 you can spend on that credit card, and you spend $2,000, right? So that's 1/10. You're using 10% of credit capacity. But let's say you spend 18,000, 20,000 every month, but you pay off. You're using 100% of the capacity. So credit score grows by making that fraction as large as possible. So that's why you want to have a very large credit capacity at the bottom, the denominator. So if you have a mortgage, that makes the denominator very large, right? But if you have a mortgage and many credit cards, the denominator is very large. But in a $20,000 credit card, you don't use even 500 every month, your credit score is gently going to increase. Also, one other thing I would say, if you have multiple credit cards and you have to close or cancel a credit card, please do not, close the most recent one. Keep your credit card that you like and have been around for a long time. Do not close those. And one way to keep a credit card that's been around for a long time is to do one transaction or two transactions a year and just leave it. Do nothing. And that's another. So do not be churning credit cards. The one that you want, to keep for long haul, that'll improve your credit score. The length of your credit also matters.
These are
Anything
these are
else?
great advices, Sanjay Dai. Thank you so much. It's almost 8, and we will have to bring this conversation to a close. But thank you so much. We really appreciate your time and willingness to pour into this new generation of leaders. And thank you everyone for joining. You guys will have a special place in my heart because you guys will be the first audience for my leadership speaker series journey. I hope you are leaving with great insights that you can apply in your life, whether you're a student, career, professional, or already on your leadership path. If you loved today's session, we'd love to see you in our upcoming session on February 4, featuring Copil Mishra, managing partner of SP Cap Group. If you haven't RSVP'd for it, go ahead and RSVP, and I'd love to see you in that event. You will get to learn about real estate investing a little more. With that, we'll wrap it up for today. Sanjay Dai, again, thank you so much for being here, and would love to stay in touch with you. And thank you, everyone, for being here. Have a great rest of the day.
Alicia, thank you very much. And thank you for everyone for participating.
Thank you so much,
All the
Dana.
best.
Thank you.
Bye-bye.
All the best. Bye. Bye,
Bye.
everyone.